everyone, welcome back to ACCA By Rida, and in this video we are heading towards our ACCA F3 Financial Accounting Chapter 1 Part 2. So before I start, I want to thank all of you for the incredible responses on Part 1 of Chapter 1. I've received so many of your messages about how you're enjoying the way I explain things. So let's dive deeper into Chapter 1 Part 2. So in Part 1, we introduced the basics of financial accounting, its purpose and importance. Now in Part 2, we are going to take a closer look at the elements of financial statements and accounting principles, financial statements, different types of financial statements. So understanding these thoroughly is crucial because they form the foundation of everything we'll be learning ahead. So the elements of financial statements or the heads of accounts, I already make a video for that in the past videos. I will mention the link in the description box, you can check it out. So it's fine to remind these elements here in this chapter because it's a part of this chapter. So let's begin. So first we have assets. Assets are the resources controlled by the business that are expected to bring future benefits. And this could include cash, equipment, land or building, or prepaid rent, insurance, like this. So a quick example, if you buy a car for your business, it's an asset because it helps the business operate and adds value over time. Then we have liabilities. Liabilities are the amounts the business owes to others. So think of loans or amounts owed to suppliers. For example, if your business takes a loan from a bank, so that's a liability because you need to repay it. So then we have equity. Equity represents the owner's interest in the business. After all the liabilities are subtracted from assets, so for example, if a business has assets of 1 lakh and liabilities of 30,000, so the equity would be 70,000. Simple as that. Then we have revenue and expenses. So revenue is the income earned from the sale of goods or services. For example, if a shop sells clothes, so the money it earns from those sales is revenue. And expenses on the other hand are the cost incurred to earn that revenue, like rent, shop rent, utilities or wages, right? So understanding these terms is vital because they directly impact the financial performance of any business. So now there are some accounting principles and concepts, right? So first is going concern concept. It is the one fundamental concept, and this principle assumes that a business will continue to operate indefinitely. For instance, when preparing financial statements, we don't usually consider the possibility of closing down or selling off assets unless there's evidence suggesting that might happen, right? So for instance, when preparing financial statements, we don't usually consider the possibility of closing down or selling off assets unless there is evidence suggesting that might happen. So now what the accrual principle says. This principle dictates that income and expenses, income means revenue and expenses should be recorded when they are earned or incurred, not necessarily when cash changes hand. For example, if you provide a service in December, right, but you receive payment in January, so the revenue still gets recorded in December as that's when the service was provided. It's just simple. Then we have the consistency principle. So the consistency is key in accounting, and this principle means that once a business adopts an accounting method like depreciation, right, or it should continue to use it for future periods. For example, if a business or if you choose to use the first in first out FIFO inventory valuation method, so you should stick with it so that financial results are comparable over time. Or we can take any other method as well, or like depreciation method, right? There are two types of method, like straight line method and the declining method. So the business has to stick to that method, and that will be continue in the future as well. So the prudence principle suggests that accountants should be cautious when estimating income or expenses. Essentially, it means recognizing expenses and liabilities as soon as possible, but only recognizing revenues when they are assured. Correct? So let's put these principles into a practical scenario to see how they work. Now imagine a company that provides consultancy services, right? It has several assets like office furniture, computers, and cash reserves, as well as liabilities like a bank loan. So, if it's operating under the going concern concept, we assume it will continue to operate and pay off the loan over time. If we look at revenue and expenses, so let's say the company performed services in December and received payment in January. So according to the accrual concept, accrual principle, that revenue gets recorded in December, aligning with when the services were completed. Right? So I hope you understand my point, and with the examples as well. And if not, you can rewind this video and understand these points again. So each of these elements comes together in financial statements, like the statement of financial position, which we also know as balance sheet, and statement of profit and loss, which is known as income statement as well in the old time. So the statement of financial position gives a snapshot of assets, liabilities, and equities at a specific point in time. And the statement of profit and loss, on the other hand, shows the revenue and expenses over a period, providing insights into profitability. For instance, if you see that a business has high liabilities relative to assets, so it might indicate financial risk, right? So alternatively, strong revenues and controlled expenses reflect healthy business operations. So financial statements provide a structured way for a company to communicate its financial activities and health. And these statements are created based on accounting standards like IFRS or GAAP, which ensures consistency, reliability, and comparability. So there are mainly 5 types of financial statements. First one is statement of financial position, which we also know as balance sheet. Then we have statement of profit and loss, which we also know as income statement. On the third number, we have statement of cash flows, and then statement of changes in equity, and then notes to the financial statement users. So the statement of financial position, also known as the balance sheet, and is a snapshot of a company's financial position at a specific point in time, and it shows 3 main elements: assets, liabilities, and equity. So the basic accounting equation forms the basis of the balance sheet, right? So the total assets is equal to liabilities plus equity. Now let's break down the components further into current and non-current categories. Let's first understand assets. So assets have 2 categories: current assets and non-current assets. So current assets are resources expected to be converted into cash or used up within 1 year or within the business's operating cycle, whichever is longer. So they are essential for day-to-day operations. So examples like cash and cash equivalent. So here cash we use in the daily basis, right? And the cash equivalents like money in hand or in the bank, or cash equivalents like bonds that are easily to be converted into cash. Then we have accounts receivable. That means money owed by the customers for sales made on credit. Then inventory, goods available for sale, stock, right? Then we have prepaid expenses. As I told you before, prepaid expenses like that we have already paid, but we don't get benefit from it, like rent or insurance, that payments we have paid in advance, right? So now let's talk about the non-current assets, which are fixed assets, and these assets are resources that provide value over a long period, typically more than a year. So these are used to run the business and are not meant for quick conversion into cash. For example, property, plant and equipment, which has a short form of PPE, in which land, building, machinery and vehicles are included. Then we have intangible assets, right? Intangible assets like patents, trademarks, goodwill, like reputation, it's basically. Then we have investments like long-term investments in stocks or bonds, right? So it's all about the assets. Now let's move on to the liabilities. So liabilities have also current and non-current categories. So current liabilities are obligations the company must pay off within a year or within its operating cycle. For example, accounts payable, that money owed to suppliers for goods or services. Then we have short-term loans that must be repaid within a year. Then we have accrued expenses incurred but not yet paid, like salaries or utilities. Then we have unearned revenue, money that received in advance for services yet to be provided. So then we have non-current liabilities, that are long-term liabilities that have a life of more than a year. So non-current liabilities are obligations that are due beyond 1 year, right? And these are usually related to financing the business over the long term. For example, long-term loans, bank loans or bonds payable with maturity beyond a year. Lease obligations, like payments due to under long-term lease agreements. Deferred tax liabilities, that taxes that are owed but not yet payable. So here is an example for better understanding. Suppose a company has the following, right? So in this case, the balance sheet would reflect total assets, like the total amount of current assets plus non-current assets. It will be $92,000. Then we have total liabilities, current liabilities, right, plus non-current liabilities, we got $43,000. So the equity would be calculated as assets less liabilities. So we get the total equity. So now let's talk about the income statement, which is the statement of profit and loss. It provides a summary of a business financial performance over a specific period, such as a month, quarter or year. And it shows how much revenue income a company has earned and the expenses it has incurred, leading to either a net profit if revenue is greater than expenses, or net loss if expenses exceed revenue. So here is a simple formula: net income is equal to revenue less expenses. So let's understand. Here is a basic format of an income statement that you have to memorize it. That revenue, sales means revenue, right? So this includes all the income generated from selling goods or services, less cost of goods sold, COGS, the direct cost of producing goods sold by the business. Example, raw material, labor, right? By subtracting cost of goods sold by the sales, we get gross profit value. Then by the gross profit, we have to less operating expenses. These are the day-to-day expenses required to run the business, such as rent, utilities, salaries and marketing cost. So from that we got operating profit, EBIT, right? EBIT, which means expenses before interest and taxes, right? So after this operating profit value, we have to less the interest and taxes amount, right? Interest on loans and applicable taxes are deducted here. So after that we get net profit or net loss. So now the statement of cash flows. In this statement, it shows how much cash moves in and out of a business over a specific period. And this statement is divided into three parts. Operating activities, cash generated from day-to-day business operations. Then we have investing activities, cash spent or received from buying or selling long-term assets like equipment or property. Then we have financing activities, which says cash related to borrowing, repaying debt, or issuing shares. So guys, in ACCA F3, the statement of cash flows is covered in detail in a separate chapter. You can check it out in the Kaplan study text index. And for now, just remember it's about tracking how cash flows through a business, right, which helps in understanding the company's financial health. And then we have the statement of changes in equity that reflects how the owner's equity changes over a time, and it includes profits retained in the business, dividends paid out, and any capital contributions or withdrawal by the owner. Right, so it components have like opening equity, the starting balance of equity, then we have to add the net income earned during the period and any new investments, right? Then we have to subtract the dividends paid to the shareholders or any capital withdrawals. For example, suppose a company starts with an equity of $50,000 and earns a net profit of $10,000 and pays dividend of $2,000. So the closing equity would be 58,000. But don't worry if you not get my point, you can rewind it. But before rewinding, I would like to share this, that the statement of changes in equity has a separate topic which we will cover later on. So mastering these concepts is essential as they set the groundwork for accurately analyzing financial statements, and which will help in our next chapters. So thank you so much for watching. I hope this deep dive into chapter 1 part 2 has clarified the building blocks of financial statements and essential accounting principles as well, and the financial statements, brief introduction to the financial statements as well. So your support and feedback mean the world to me, and please keep the messages coming and let me know if there's anything specific you would like me to cover in upcoming lectures. So remember to like, subscribe and share if you found this video helpful. I will see you in the next video.